Okay, well, it is 6:30 and we're going to go ahead and kick this off again. This is night two of Grain Market Navigator, and we're excited to see you guys all back. And hi to the host sites in person around the state. We have Jonathan Laporte back with us again tonight. He is the Farm Business Management Educator for Michigan State University Extension. He educates farmers and agribusinesses in farm business principles with an emphasis on production, economics, and risk management. So, tonight he's going to dive a little bit deeper into the grain marketing process. And you should have a couple handouts from an email from Jenna that might be handy to have in front of you while he goes through his presentation. It's the minimum price contract worksheet and the hedge to arrive contract worksheet. So probably work through that together. And I think we'll just go ahead and throw it on over to Mr. Laporte.
Sounds good. Thank you, Courtney. Share my screen. Everything look good on your end there?
Looks great.
Awesome. All right. So last time around, we talked about the market environment, kind of some introduction on some basics. We are still going to do some terminology discussion today. There's some key things we want to kind of remember as we're looking at different market contracts, and so going to try to walk you through some of those. But the main emphasis today is to kind of show you how some of these things work, maybe some advantages that some contracts maybe have over others, depending on the situations you're seeing out in the market. So the first thing I want to highlight is there are a number of different contracting options out there. A lot of different, as we call them, pricing decision tools that you have at your disposal. And we're going to walk through each one of these a little bit today. And I start out with storing unpriced grain because a lot of people think, well, if you just stick it in the bin and wait for a price, that's not really a decision tool, but it actually is. It is an option that's available for people. One of the things that I often advocate is that it's not your only tool that you're trying to utilize on the farm. And so when we think starting out there with storing unpriced grain, it's probably the most common option used by producers. When we look actually at some data from USDA over the years, especially the last 10 years or so, that we don't have a lot of folks that do some pre-harvest marketing. A lot of folks are going to wait till we get to harvest time. They're going to stick those bushels in the bin and wait to kind of see where the markets go. And so I'm kind of hoping that by the end of tonight, if you're not familiar with some of these other options, you're going to see some potential or tools that you could use. For some of you that maybe are a little bit more familiar with some of these, maybe learn about a few other tools to kind of partner with the ones you're already using. So with stored grain, it relies a lot on normal pricing patterns. We talked last time about that normal marketing trend, the normal patterns we look for, and the fact that really that there's not a whole lot of normal that's been out there recently, and so it's really tough to have a lot of great expectations in terms of markets doing what we expect. We did see some things that, when we typically find that the prices are better than the market year average in certain months. Some of those cases for corn or soybeans maybe were that January, February, March, maybe into April time span. And so what ends up happening is because we're relying on normal pricing patterns, sometimes we run into this idea of pricing um, on a downward trend compared to where we want to be. And so we're really talking about more of a spot market transaction where we're just going to price it when we deliver it. We're not really setting anything in motion. We're not securing any price. We're just going to take whatever the price is at the time we decide we need to deliver it. And it's a useful tool, especially if you're trying to move some bushels because you've got a payment coming up on maybe some debts, or you're looking to uh, get some fertilizer bought in the fall. There's a lot of cases where spot markets and maybe storing that grain for a little bit into the fall, or maybe as you're looking to price some things on inputs on when you change the new year into January, February, you kind of want to base that decision more on when you're actually looking for what you're going to use the cash for. So there's some advantages to it, but you want to be careful because there's a lot of things that can happen, and there's really no risk protection if you're just going to store it in the bin and have it unpriced. So that question of what if price patterns aren't normal, kind of like what we've seen before. And so what we want to also kind of keep in mind is that when you store grain, it's not really just sitting there kind of rent free either. So there is actually some cost to actually having that grain sit there in the bin. And we often refer to these as the cost of ownership. And there's two primary things that you want to look at for the cost of ownership. One is the actual cost of storing the grain, and the other is actually the opportunity cost of the interest on maybe borrowed money. So we think about if we were to sell the grain and we had the money, it's kind of the same idea of the time value of money. We're starting to kind of get to that idea of money is worth more now than what it is down the road, worth more today than in the future. And so we want to kind of compare, at least have in our heads what these numbers are as we think about the cost of actually having that grain sitting there in storage for, even a month, a couple of months, as we're thinking about pricing down the line. For storage costs, this is actually pretty straightforward to think about. You've got really all the costs that go into actually keeping that grain in good condition in that bin. And that may be if you're trying to dry it down, you're trying to get it to an ideal moisture for storage. Corn, where we want to be around 15.5 maybe, or 15 percent moisture. And so if we're thinking along the lines of trying to get things to a storable um, moisture level, we've got costs of fuel. Maybe there's some maintenance and repairs on keeping the bin in good condition. We may have some other fixed costs that go into some of this. For example, if you've got any of your farm insurance, if you're paying some extra insurance for coverage on those storage facilities, on those grain bins, you want to think about associating some of that, allocating some of that cost to what that storage actually kind of has to pay you back to cover those expenses. Same with any real estate taxes, which I know is a little bit hard to kind of figure out because for a lot of people, the storage bins maybe take up a very small footprint on maybe a farm. Maybe it's less than an acre, or maybe it's a couple acres, depending on the size of your operation. So that number may be a little bit challenging, but you identify the costs that go into really maintaining and having that storage, utilizing that storage, those operational costs, some of those overhead type costs, and then you use those, take those values, divide that by the number of bushels that you're planning to store, and then by the number of months in a year that you're planning to store it. Now, a lot of cases, people will divide that number by 12 months just to kind of get an idea of what's my per month cost. But you can look at a total number as well. Sometimes it's a little easier that if you don't want to do the math, you can use commercial storage rates. The only caveat I would give you with that is that it typically costs less to store on the farm versus storing at commercial storage. Your grain elevators, your grain buyers, they're going to have higher storage costs because they're doing the same thing you're doing in terms of calculating what cost they're transferring to the bin, like what the bin is supposed to pay them to have them, and they have a lot higher costs usually than what you do that they're going to try to transfer over. And so it's not always the best way to really think about pricing, but in a pinch, it's a good starting point. The other thing I would talk about, or I would ask you to think about in terms of these numbers is When we think about using storage costs in terms of pricing targets and our margin goals and what kind of price we're looking for out on that market, you want to be cognizant of or be aware of the fact that how many of these expenses have you already allocated to your cost of production? And so in some cases, these fixed costs like insurance, real estate taxes, those type of things, you may have already got kind of grouped into your per acre number for your cost of production, in which case you're looking really at the variable costs of, okay, I haven't spent the money yet to dry the bushels. I haven't spent the money yet to maybe aerate, put the fan on those bushels. So you're going to have some additional costs, and that's kind of where that storage cost starts to get a lot cheaper for people is we're only looking at the operational costs that are in addition to what we know we're already covering and through our typical cost of production. In terms of calculating an interest charge, this is the more of an opportunity cost type idea where you look at that cash price that's available and you take the interest rate. Maybe it's on an existing loan you have, maybe on the current available interest rate at a lender right now. There may be the United States government has kind of a 20-year Fed note that you can look at to get an idea of maybe an interest rate. But you take that interest rate, multiply it by the cash price that you're looking at, and then go same as you did for storage, you divide that by the number of bushels that you're going to have in storage, and then how many months you're typically looking at storing. And again, you could do it by 12 months just to get a month to month average. That's kind of your opportunity cost. That's kind of money you're giving up to keep that grain out there. And you kind of want to think about that as, well, we want to get more than that in our pricing targets if we're going to keep that amount of bushels in that storage. Okay. So when we think about cost of ownership, it's really both of these two numbers. It's your storage cost to actually house those bushels and keep them in good condition. And then it's also this interest charge of the opportunity cost of what that money could be worth today versus down the road that we're trying to equate to, that we want to make sure we're getting better than that if we're going to hold on to it. And these are important concepts as you're thinking about anytime you're going to store, because we're going to talk about a couple other pricing. Storage is a part of that, and you want to make sure you're thinking about those storage charges um, as you're kind of going along and thinking about prices. And we'll walk through some of those examples when we get to some of the other contracts. I want to start with futures contracts to talk about this because these tend to be some of the most confusing things for people to kind of get their heads wrapped around. This is where we're going to talk into some of the additional terminology. I'm going to walk you through some basic examples on what some of these terms mean. Then we'll kind of move into futures options and kind of walk through how that affects the futures contracts themselves. So first thing to understand about a futures contract is it is your opportunity to sell or take delivery of grain. This is a very important concept because everything there is to do about futures contract is that you are either going to take delivery of grain or you're going to sell grain based on these contracts. Doesn't mean you're actually going to do that, but the market operates as if you are going to do that. And we have a lot of speculators that will enter one area of the futures market and get out of another. The market, the contracts basically change hands, and they might buy or sell a contract, and that gets them back. They've entered the market, they're going to get out of the market. And that's kind of what a lot of producers do as well, but they're doing it on a little bit more limited scale than maybe some of these traders are. And the reason for that is that the standard amount of grain on a contract is about 5,000 bushels. That's still the case for corn, soybeans, and wheat. There are mini contracts that you can get out there for less bushels, but the standard amount is typically 5,000. And so if you're talking about a standard futures contract, that's a lot of bushels. It's a lot of bushels for most farms to have to take delivery on or to try to sell. You have to sell it and actually deliver it. If you're going to sell it, you're going to deliver to an actual futures port somewhere, which is maybe not going to be your local elevator, usually a lot further away. But this is the amount of bushels you're looking at in terms of what's on a contract. And because of the amount of bushels that are on these contracts and the intricacies that we're kind of walk through in some of these terms, there's a lot of brokerage firms that actually manage these contracts and these things called futures margins. And so you're going to be working with them to actually kind of manage these contracts. And there's also a lot of money that's going to be changing hand for some farms. So let's talk about what these futures margins are and kind of get you introduced to some of the inner workings on these contracts. The first thing is to understand what's called an initial or the origin margin. And an initial margin, sometimes it's even just called the margin, is the amount used to establish and own a futures contract. And it's usually a percentage of the total value. In a lot of cases, it's a smaller percentage. I'm going to walk you through an example that has this in it. My numbers are going to be a little bit larger than what's currently on the board today, but I'm using whole numbers to try to make the math easier for you. The maintenance margin is the minimum balance needed to keep that contract open. So there's an initial amount of money that you're going to pay to establish the contract, and then you have to make sure that that contract, the value of that contract, actually stays basically above a minimum. And that's what this maintenance level is. So that value, it can go down to whatever that maintenance value is. But if it falls below, then we start to worry about this thing called a margin call. And that's the amount of money needed to bring the contract back up to the initial total value. And so we have a margin call when the value of the contract falls below the maintenance margin. So we start out this initial margin, the money we're putting in to own that contract, to get it established. We have a maintenance margin that we use to make sure that, we've got a minimum amount of money sitting there, keeping ownership of that contract. But if the value is the prices on the futures market go up or down, depending on what we're looking at, uh, if we're talking about the pricing going down, if it gets below whatever this minimum balance is, then we have a margin call and we have to bring the value back up to that original margin that we start out with. So this original amount of money that we put into it. So you could theoretically start out putting in a certain amount of money and then end up having to add even more money to keep that contract open. And so it's not just a matter of, you're going to put in, say, $1,000 or $900 and that's it. You could potentially be paying more money. And we're going to walk through an example of that actually here. So again, margin call is the amount of money needed to bring that contract back up to that initial total value, that initial margin. And it's made when the value of the contract falls below where we've lost the money. We've lost money that we're falling below that maintenance margin. So walk through an example this here. We've got a contract value, $21,250. We're looking at a 425 contract on corn at 5,000 bushels. You've got an initial margin of 2 grand. So we put 2 grand on this contract to establish it. We have a maintenance margin of 1,500. And so this question, we start with how much money can be lost before a margin call is needed. Well, to do that, we've got to look at these two numbers, this initial margin and this maintenance margin. And it's really simple math here, where we take 2,000 minus the 1,500, and we're talking about $500. And so we've got about a $500 wiggle room that if that contract loses $500 and we hit that maintenance margin, we're okay because we haven't gone past the 500. But as soon as we go past 500, then we've got to turn around, we've got to pay more money. And so let's say that actually happened. Let's say the futures price falls from 425 down to 405. This $500, we're talking about 10 cents. 5,000 bushels at 10 cents is about $500. Well, we've dropped about 20 cents. So we've exceeded our maintenance margin, our cushion, what we can lose is that 500. So we've lost actually, we're actually lower than the maintenance margin. We have to bring it back up to the 2,000. And because we're at 20 cents lost, we're at $1,000 that we've lost in value. Well, we only had 500 to give, so now we actually have to pay 1,000 back into this. So end up now what we've actually, and I don't have this on the screen, I apologize. I should show the better number on this. Now we have invested, instead of just the 2,000 that we had invested already, we have actually lost uh another $1,000, and we have to reinvest another thousand. So we're actually talking about a total of 3,000 that we have actually now had to invest if we're going to keep this contract open. And so we have to ask ourselves some very important questions. First, do we think the price will go back up and we're going to recapture the losses? Are we going to get basically a 30-cent swing in this example to capture what we've lost and just bring us back to where we wanted to be initially? Or to possibly more than that. We'd really like to see more than 30 cents, so we're kind of getting back more than what we've already invested. If we think the answer is yes, we're going to pay the margin call and keep the contract. If we think the answer is no, we're going to close or sell out the futures contract, get rid of this margin call, and just take our losses. And it's this kind of thing, this kind of environment where we have to worry about putting more money into this contract and trying to recapture what we've added investment, is why a lot of people get caught in futures contracts. We've seen over history where a lot of farms that have kind of, as they call it, played the markets, have lost a lot of money, if not gone broke farming, not because they were bad farm managers, but because they got caught up in the futures contract, to the futures market, playing with these contracts, and they overinvested. And in some cases, you just have that kind of situation where you have to know when it's a good time to get out, or in some cases, not invest a whole lot based on what your situation is. So very challenging to understand these. A lot of moving pieces. I did want to show an example of what this actually looks like. Um, and so I'm actually going to uh, bring this down for a moment. I think this is still showing on my screen here, which should be the bar chart. And I'm happy to see that it's actually showing an appropriate ad that makes more sense for our conversation today. I was mentioning to our host that the ads keep changing and they're a little interesting. But here on bar chart, you can look at, we're looking at December corn, and you actually can see for this futures contract, and I apologize, a little hard to see. Maybe I zoom in a little bit. You see this margin and maintenance level. We can see on December corn futures, we're actually looking at an initial margin of actually $1,000 and $1,072, and a maintenance margin of 975. So not as big a numbers as what I was showing on the example, but kind of gives you an idea of what you have to pay in to establish that contract, and kind of what we need to see in terms of the value to maintain it. You see that there's not a lot of difference between these two numbers. And so it doesn't take a whole lot of price movement to kind of impact that. Now, a lot of times these contracts, we don't necessarily see huge swings on a day-to-day basis, but depending on how volatile the markets can be, we can. And so it's not an everyday thing, but it's one of those things you've kind of got to keep in mind, that there's a little bit more at risk when you've got tighter differences between those contracts, the maintenance margin and what you initially put into it. So we'll skip ahead here. So I want to talk about this idea of hedging, because hedging is really important for futures contracts. It actually also applies to a lot of the other decision tools that we're going to talk about. Um, the first thing to understand about hedging is that you're going to be taking equal but opposite positions in either the cash or the futures market. And so an opposite position in one market is intended to offset the risk in another. So producers with grain to sell start with the position in the cash market. You've raised the bushels, you've harvested those bushels. you own the product at that point. So you're already in the cash market at that time. You're looking to eventually sell those bushels and get cash for them. Your cost of production is essentially the price you paid to be in that market. And that's why that's your minimum market price, because that's what you paid to establish yourself in the cash market. If you store grain, you stay in the cash market. And that's what we call being long in the market. Anytime you're storing bushels, you may hear where people that are being long in the market, you've got that grain on hand. You're keeping that grain. An opposite position is either to sell or sell a futures contract or lock in a futures price. And we're going to talk about um, locking in futures price on some of these examples as we go along. But the idea is that you're going to be in one market. So if you're in the cash market, you theoretically want to exit the futures market. You don't want to be in a position where um, you're trying to get into the market. So if you're selling a futures contract, the idea is that you're selling the theoretical bushels on that contract, and so you're trying to exit the futures market from that position. It gets a little bit terminology heavy from the stack that if you're selling a futures contract, you're technically still in the market because your position is to sell a contract. Um, but it's the idea that you're trying to stay in one market because you still have the bushels. You're theoretically saying in the futures market, I'm getting rid of the bushels I theoretically have in the futures market. Now, if you sell your grain, that you have that stored in the bin, you're exiting the cash market. And that's being known as being short in the market because you're getting rid of those bushels. The opposite position in the futures market would be to buy a futures contract to say I'm essentially buying the bushels that exist in that market to put myself in the futures market that way. So it's this idea of where do your bushels theoretically exist? Are we selling them or are we buying them in one market versus the other? Again, if you've raised bushels, you automatically you've bought your way into the cash market. Once you sell them, you're exiting the cash market, and then you're looking at if you're going to hedge, you would then enter the futures market theoretically to buy bushels there. And so that's kind of this back and forth where we talk about with everything around futures contracts, everything fundamentally works around this idea of are you buying or selling bushels in that market? And so that's where this gets a little confusing is you've got to kind of have that mindset squared away in your mind, that understanding of buying versus selling bushels in futures. And then the rest of this kind of starts to make sense, but it gets a little twisted up sometimes. I get a little twisted up trying to explain it. So if any of this is confusing, and we need to kind of walk through some more on this, we can. And then especially when we get to the end, we've got time for questions. We'll talk more through this as well. Now, one of the key things that we want to talk about when we think about futures is that once you're theoretically in that futures market, you need a way out. And this is true whether or not you're selling a contract or you're buying a contract. If you have any kind of futures contract, you eventually need to get rid of that contract you have. And so, regardless of whether or not you're going to theoretically deliver the bushels on a contract or you're going to take delivery of that contract, you need to do something. And this is where hedging is we're technically going to take a position, an opposite position in the market. And again, back to this idea of we're exiting one market going to another. This is where we start to think about the opposite effect of if we've sold a futures contract, then we need to basically buy it back. And that's where we kind of think about hedging here, where we're buying it back to um, basically offset whatever position we're in the futures market. If we bought a contract to start with, we have to sell the contract to offset and exit the futures. And so in either case, depending on which direction you start from, if you bought a futures contract or if you sold, you have to do the opposite. Theoretically, if you were going to be taking delivery of the bushels, then you'd be re-entering the cash market if you actually took delivery. But in most cases, people don't actually take delivery. They use these things called options to kind of assist with them getting out of one market or the other to try to still capture some profit and then exit the futures market. We're going to walk through futures, but we've got to kind of walk through a few more terms here to kind of catch you up on what that is. Um, and so, first thing we want to look into is what's called a put option, and this is the opportunity to sell a futures contract, so that right to deliver grain on the futures market. We also have what's called a call option, which is the opportunity to buy a futures or the right to receive grain. Options are really an entry or exit point into the futures market. A lot of people use these to position themselves to make one move or the other. And they use these preset price levels called strike prices, and they've got different increments depending on the commodity you're talking about that you can actually set them at. And so for each commodity, we may see a strike price of, for soybeans, it's based on every 25 cents. For corn, every 10 cents. Wheat, here the last couple of years, they upped it to every 10 cents. It used to be every 5 cents. But then after the last couple of years, when we had such high run up on wheat prices, they moved it up to 10 cents like corn. And so strike prices are a really important part of depending on where you're going to set that at, to whether or not the actual put or call option is going to work to your favor. And so some common terminology that you want to get comfortable with if you're looking at put or calls is first this idea of being in the money. And this is when exercising an option, either a put or a call, equals a positive gain. You're making money based on what's going on. So if we think about a put option, the opportunity to sell, our futures price is going to be below our strike price. So we have the right to sell at a higher price. So an example of this would be our strike prices for soybeans would be about 10.50, and the futures price ends up being 10 cents. Well, because we have the put option, we have the opportunity to sell or the right to sell at 10.50 instead of 10. So we're gaining 50 cents on that sale. And so that's where we're in the money. We're making money on this. With a call option, we kind of think the reverse in terms of, again, if the futures price is above the strike price, we have the right to buy at a lower price. So in this case, say our strike price is at $8, futures price is 8.50. We don't want to buy bushels at 8.50 if we can buy them for $8. So we're actually gaining 50 cents in this example because we're going to buy them at a cheaper price than what the market's currently offering. And this is kind of where you want to set yourself up in with put options or call options is you're looking to gain some advantage where you think that there's going to be an opportunity that if you think the market's going to move one direction, you're using one of these options to position yourself to be at a better position, whether you can sell at a higher price or buy at a lower price, depending on what action you've already taken in the futures. Now, then, if we're talking about in the money to make money, then we have the opposite concern of where we don't want to be out of the money, where when we exercise that option, there's no positive gain. So in this case, we're talking about with a put option, it's the reverse. The futures price is above the strike price, so we have the right to sell at a lower price on the market. So in this case, say our strike price was at $10, the futures goes up to 10.50. Well, we don't want to sell at 10 if we can sell it at 10.50. So we're not going to exercise our right to use the put option because it means we're going to be selling for less. So we're out of the money. We're not getting any benefit out of our ability to sell. Call options, same idea, but in this case, we're talking when the futures price is below our strike price. So we have the right to buy at a higher price. And so if we look at this strike price of 8.50, futures price at $8, but we don't want to spend 50 cents more to buy these bushels using our call option. We would rather just spend the $8 that's available on the market now. So we're not going to exercise our call option because we're out of the money. We're not getting any kind of positive gain. So we've got in the money, making money, basically making money, out of the money, not making anything. And then we have this thing called at the money. where the strike price and the futures prices are the exact same. And so in this case, we're talking about a case where uh, $10 on the strike price, $10 on futures price. So there's no gain or loss in this case. It's exactly the same. And even though we're talking about in increments of either 25 cents or 10 cents, what I often explain to people is think about it as just even a change of a penny is going to put you either in or out of the money if that were the case. So when you're looking at the futures price, if that futures price goes up or down 1 penny, you're either going to be in the money or out of the money. And that's where we kind of watch those future prices, see are we in the money? And if we are, then we have to make a decision to actually exercise that option. Or if we're out of the money, do we think we're going to be able to eventually get back in the money, and kind of keep that going along? Options have a premium that you've got to pay. Even if you're not going to use them, even if you decide not to exercise them, you still have to pay the premium. And so that's really considered kind of the value of the option or maybe the price of insurance. And so before you get into using options, you want to see what those premiums are. Um, and that's something you learn talking to brokerages. You can talk to the grain elevators if you're working through them. In a lot of the cases, they've got people there that will actually manage those, and they can tell you what those premiums are going to be. Um, and so you want to know what those are and kind of plan that into what am I paying, because that kind of tells you where you again price targeting. I'll make sure I'm covering my cost, kind of like we were talking about the cost of ownership before on storing grain. We want to make sure we're covering above the cost we have to have that option sitting out there for us. So we're going to move away now from futures and futures options, talk about some tools that are a little bit more straightforward, not as many moving pieces, not as much investment maybe as what we were talking about with futures, where they're options. And I want to start with a forward contract because this is really probably the most straightforward. Um, and we talked before about with hedging that if you're taking a position in the cash market to store grain, that you're taking an opposite position in the futures, either to sell a contract or to lock in a price. And you do that with a forward contract. You're actually setting the cash price at the time of the establishment of the contract. And it actually locks in the futures price. It also locks in the basis because you're establishing what that cash price is ultimately going to be. The one nice thing about a forward contract that you have, or a couple nice things, is there's no quantity requirements. So it's not like a forward or a futures contract where it's 5,000 bushels or so. Um, the delivery is at a later date, so you can think about what your storage costs, those cost of ownerships are maybe at to decide is that a good price that we're seeing. And you can set that contract in this case, where an example is you could set it in September with the idea you're going to deliver it in December. And one of the nice things about a forward contract is they're pretty easy to understand. And you're dealing with people you know. You're not worried about what's going on necessarily dealing with traders or brokerage firms. You're talking to those grain elevators that you're going to deliver these to. So these are people that are typically, in your community, people that, you maybe see on the weekends at a restaurant or at a sporting event. So it kind of helps. In some cases, these are a little bit more comfortable for people, especially not having a quantity requirement. You can set those based on as many bushels as you'd like, maybe minimum wise, depending on what the grain elevator what has. You can actually set them for lower amounts than typical. Like a lot of people will look at, you know, instead of 1,000 bushel semi load, can I do it for lower than that? What those minimums may be. So you've got some options with a forward contract, but the big key is you're establishing that cash price. So if you see a price that covers your cost of production, covers your storage costs, maybe covers those interest charges, that opportunity cost you're looking at, then you can kind of look and say, I'm making money in that price, so I want to lock in some of my bushels with a forward contract and secure some profit on at least those bushels. Really good tool to use when you're thinking about making some fall purchases, or maybe especially after the first part of the year, if you know that you need to spend some money on inputs, maybe making some of those debt payments we talked about the last time around last week, good option to use. Another pricing tool that can be pretty helpful is this delayed pricing contract. This is where you're actually going to deliver the grain now or at a specified date. You're going to price it at a later date. Technically, the elevator owns the grain, and you're going to pay storage fees. There's some flexibility with this that you're basically looking to price it later. So you're kind of hoping there's a better price that's going to come along if you think that opportunity exists. And this is a real advantage for people that don't have grain storage. They want to be able to do some pricing later. There are some opportunities that maybe might come along that you think are out there in the market, but storage is your hindrance. So you could use a delayed pricing contract to at least do some storage with the commercial elevator or grain buyer. Just like forward contracts, there's no quantity requirement. And again, it's easy to understand. You're going to deal with people you know. And in some cases, I know for Michigan, I don't know if it's true for Indiana, but a lot of Michigan grain elevators, they'll actually give you a period where, and I know this, I've talked to our folks in some of the grain elevators about wheat, that a lot of cases during the wheat harvest for wheat growers, that they'll actually give them up to I think it's up till August 31st, where they won't actually charge anybody some of those delayed pricing charges to give them an opportunity to gain some additional market advantage. However, once you get past that date of August 31st, then they not only start charging you for what the actual cost would be going forward, but they retroactively charge you for those months that it's been sitting in storage too. So there's some risk reward involved in that. You kind of want to decide to use this. If you've got grain elevators in Indiana doing the same thing, know what those timetables are because you could possibly price yourself in some really good windows, getting some of that basically some free charges or free storage, or at least reduced storage in those cases. Now, basis contract, we've talked about forward contract, delayed pricing. Delayed pricing is used in some cases. Now we're going to start talking about basis contracts, which are very, very popular. The next couple one of these we're actually going to talk about are fairly popular for a lot of people. And so basis contract, we talked last time about basis and this idea of it getting narrower or strong or strengthening as that difference between cash and futures gets closer, or sometimes cash gets above futures, or the idea that we're looking at whether it's widening or weakening where that gap gets between cash and futures gets further apart. The idea with basis contract is that you're going to lock in that basis. You think the basis is pretty strong, um, and you're concerned that it's going to get weaker. You think you're going to see that widening. And this provides you an opportunity where you can lock in that good basis, but that futures price is not set. And so you can kind of see where that futures price is going to go and still try to gain some advantage where we're actually looking at a price where if that futures price goes up, it kind of helps pull that cash price along with it because it keeps that gap between cash and futures set at whatever that basis level is. Whereas if you just leave grain in the bin unpriced, you got both are moving. You got futures and basis can be moving on you. And so you're kind of trying to minimize your risk by saying, I like the basis where it's at with this elevator I'm planning to deliver it to. I can lock that in. And it's based on a specific futures contract. So we're using a certain month. It may not be, you may be delivering in November, but you're basing it on a December futures because that's the next closest futures contract. The one downside to these is that futures price may not get better later on. So you're kind of looking at that risk reward of where does that futures price going to go? Do we think it's going to go higher, go lower? So you kind of got to watch that to see about locking it in. You do have to pay a premium to use this. You do have the option to do what's called rolling it forward, where if you get to that month you're going to deliver and you want to kind of play the market a little longer, you think there's some opportunity to make some more money if you hold it out a little bit longer, you can roll that contract forward. There's another fee that you pay. Each elevator is going to be a little different in terms of what they charge those fees on. So you kind of want to do some investigating at your local market to say what's that initial premium you're going to pay. And then if we do want to roll it forward, what is that premium we'd have to pay or what's that charge to move it forward another month or two? But this is very popular, especially if you get familiar with the grain elevator. We talked about the crop basis tool that Purdue has. You can kind of see, is basis kind of weak or strong compared to what it normally is? That kind of helps you kind of gauge a little bit of, are we in a good opportunity that we want to lock in basis, or do we want to go in a different direction? And sometimes that's the case where we want to go a different direction. We don't like basis. Basis we think is too weak. And so that's where we're going to want to think about using what's called a hedge to arrive or an H2A. This is really the flip reverse of a basis contract, where we're actually going to lock in the futures price because we like that, but we don't like basis. We think it's too weak. So we're hoping it's going to get a little bit stronger. And essentially, what we're looking at is it's a true advantage when that basis is really weaker than normal. So again, familiarity with where you're selling to, kind of looking what's going on in the region compared to historical numbers. Um, and this kind of helps to offset some of the risks that when we see some high price volatility, especially if we see a futures price that we really do think is a good price, we want to lock that in. Again, we're trying to kind of keep cash pulled up to a certain level, so that we're maintaining and trying to keep getting that cash price higher as time goes on. This time, instead of really having basis drag cash price along, we've kind of got futures price dragging that cash price along and hoping that that gap narrows or gets stronger for us. And so again, there's like before on basis, there's a fee that you've got to pay, but we have some of the same advantages we've talked about with these other contracts where they're pretty straightforward to follow, working with people and usually the fee is not too bad. It's similar to a lot of cases. It's similar to an option premium, and so every elevator is going to be a little different on how they charge that. And I want to walk you through an example of how this kind of works to provide you some advantages here. And so this is one of the worksheets that I sent along ahead of time. We're going to kind of walk through this together here, and I'm going to kind of walk through the math. So the first thing we look at here is we've got a futures, or excuse me, a forward contract that we're looking at a per bushel price. Everything here is per bushel. And then we have our hedge to arrive. And this is typically a good example where we're looking at, do we would just want to set a cash price, lock in what we think is profit, or do we want to kind of see, is there some opportunity we want to offset some risk by setting that futures price, but we think that basis is going to get better. It's a little weaker than normal. We want to see if we can capture some advantage. So we start out where we're looking at the futures price of 10.65 on soybeans here. The base of that delivery that we would set on the forward contract right now is about 50 cents under. And so what we're expecting is we think that that basis is maybe a little weaker than normal. We're hoping it's going to get to about 30 cents under, so a little bit closer together. So your first step here is to do the initial math of comparing what's the cash price between the forward contract and the hedge to arrive. So when we look at that, and then we'll eventually calculate the net cash price here in the next couple of steps. So first thing is we want to do this cash price. So we take the 10.65, we're going to add in this negative 50, so we get $10.15. So that's the price we're going to set if we just say locking in our profit or locking in our price of this, and we think it's a profitable price. What we're hoping is that we're more going to be over here if we go with a hedge to arrive, where if that basis were to get stronger, we've got this same 10.65 because we're going to lock this in on the futures. That basis gets better by about 20 cents. So then our cash price, we're hoping to gain that 20 cents and end up getting about 10.35 per bushel on our soybeans. Now, one of the things you've got to pay attention to is in both cases, we're still talking about storage. So we're still utilizing storage. We've got some storage costs we've got to calculate. And so for this example, I'm just going to say we're looking at a 3-month time span. So that September to maybe December window that you talking about on a previous slide. And it's about 3 cents per month. So simple math, 3 times 3, we've got 9 cents that we've got in terms of storage costs. And we're going to have that regardless of whether or not we do a forward contract or we're going to have a hedge to arrive. The main difference between the two is we are also going to have this brokerage fee or this premium fee to use the hedge to arrive about 5 cents. So when we do the initial math on that, we start with a forward contract. So we subtract 9 cents from storage from 10.15. Now we're looking at a net cash price of about $10.06. We've got the same $9 for storage. We're going to take off the 10.35 for the hedge to arrive. You got to take off that additional 5 cents. And essentially what we're looking at is because we were looking at a higher price that we were kind of targeting, we're going to end up at 10.21. So the advantage over the forward contract in this example is roughly about 15 cents that we're hoping to gain when all things are said and done. Now, what's the risk? Well, that basis could not get stronger. It could either stay the same or it could get weaker. If it stays the same, in that case, the forward contract would ultimately be better because we have the same price at 10.06 if our basis is the same, our storage is the same. Well, now we've got this 5 cent premium we used on this hedge to arrive to get the same price we had on the forward contract. So forward contract's going to be actually about 10.06, still at 10.06. The hedge to arrive is going to be about 10.01. And so there's basis risk, as we call it. You're going to hear that phrase a lot when people talk about where they think basis is going to move. That basis risk, is it going to get stronger? Is it going to get weaker? And when you're thinking about using a hedge to arrive, or even if you're thinking about using a basis contract, you're worried about basis risk. And is that risk telling you basis is probably going to go one direction, or do you think it's going to go another direction to kind of give you an idea moving forward? Um, okay. The next one we want to talk about here is this minimum price contract. I'm going to walk you through this one. This one is the math I'm going to show you on this one. We'll walk through another example on this. I want to be very upfront that there are a lot of different variations on a minimum price contract these days. I usually like to pick on the Andersons because they've got about four or five different variations on these concepts. Um, you do still see some elevators that use the base math that I'm going to walk you through, but there are a lot of different variations in terms of trying to set kind of a minimum price within the contracting to offset some of your risk. And basically, what it amounts to is a minimum price contract or something that's like a minimum price contract sets the price floor where you're going to get the benefit of whatever that cash price is, minus any premiums that maybe are involved. And you're trying to set that as your minimum floor with the idea that there's going to be some upward potential. And so when you get to the delivery point, you're guaranteed the greater of that minimum price or the current cash price, if again, if it happens to be greater. This is often considered an alternative to futures contracts and options because there's no margin calls. You don't have to invest any money ahead of time. You don't have to worry about paying additional money in. There's no maintenance margins. None of those things exist with, in most cases, with these minimum price contracts. Now, there is a fee that is very similar to an option premium. And we actually have a calculator at MSU that goes through some of these different examples and allows you to kind of plug in your own numbers that actually has the math set up on how this really works. And we're going to walk through an example of that here in a moment. But you do have to pay a premium. And that's one thing you want to pay attention to when you're looking at some type of minimum price contract, that there is a premium for using it. It's not going to be free. And so keep that in mind that it's usually that minimum price where I talk about minimum price or the current cash price, whichever is greater, you're always subtracting off that fee. Okay. So here's an example we're going to walk through. I apologize on the slides. I realized as we were getting set for today that I had a typo on the slides. So we'll walk you through the correct numbers here. We want to set the stage a little bit here, where we're talking about, again, we're going to use a forward price contract as our starting point, as kind of our cash price, because again, we're often comparing between the two. And we've got a call premium. So I talked about how we've got similar to the call option or an option premium. A lot of cases, Call options are used a lot in minimum price contracts, and we're looking at a premium in this case of about 40 cents. We still may have an additional fee that the elevator charges on top of it to kind of handle these contracts. So you may get like two types of fees technically. You've got a premium and then a usage fee. Depends on how the elevator's kind of using that. They may have just lump it all into one. But for this example, I'm separating them out just to kind of show you may have both of those because one is using that option premium that if we're using like futures contracts and futures options as our comparison point, they may just set it based on whatever that is, and then charge an additional fee for having you take the contract through them. And this is going to set this minimum price floor that we're trying to come up with. And then we're going to look at the contract call option where we're looking at, we want to have the option to buy grain at a strike price lower than where we think futures price is going to be. And we're looking at futures price at delivery in this case, in our example, about $5. Okay. So we have a current cash price of 438. Got some fees we're going to have to take out of that to get to a minimum price. We're going to calculate that one here first. But then we also have to think about our strike price and then also that futures price we think it's going to be. So we're kind of trying to figure out, are we going to be in the money? This is our target for we're going to be in the money in terms of where that call option is going to give us compared to futures. We're kind of hoping about 75 cents here. I'll kind of give you a little head start on that one because we're looking to gain that much. And I'm using some big numbers to try to help you illustrate some of this. Sometimes we're not talking a big gain like that. But we're eventually going to want to figure out that gain and then our net cash price when all is said and done. So first, let's walk through the minimum price floor. We've got 438 minus 40 cents minus that other five for the fee. We're going to be at 393 per bushel. And this again should point out this is a corn example. Um, and so we know that's going to be our minimum. So that's our cash price minus our fees, 393. So we're not going to be any lower than that because we've already taken out our fees on that. So this is our minimum price. Now we're trying to figure out if we can gain any benefit going forward based on where these options go forward. As I mentioned, we look at the gain. It's a simple matter of our strike price at 425. We want that futures price to be at $5. And if that happens, we're going to gain 75 cents. And then if we gain that 75 cents, what we end up with is a net of $4.68. So we're looking at a minimum of 393. We're kind of hoping we're going to get closer to that 468. And the comparison we have to make here to decide if we want to do this is we're going to look at our cash price, so, or forward contract price, and it's 438. So when we compare 468 to 438, it's about a 30-cent difference. And so we're hoping by using a minimum price contract, by setting a floor, offsetting some of that downward risk, we're hoping that we're going to be able to capture some additional benefit in the end and gain back not only what we paid in those premiums, but also above and beyond that. Maybe it's going to be 30 cents. In some cases, it may only be 5 cents, but the idea is we're trying to capture some additional value. And sometimes you're going to see some kind of combination of that minimum price contract with something like an H2A. And this is where we start to get into the multitude of options that exist out there. My favorite example of a minimum price and H2A combo type pricing contract is a min-max contract. I know Anderson's has it. I know that a few other grain elevators have it as well. They're the most local one to me that I know that has it, so I kind of check their stuff all the time. But you look at basically what we're talking about is you have a contract that offers the advantage of that minimum price contract where we're setting that floor and we're going to look at that greater of that premium price or that current price. But it has also the advantage of a hedge to arrive contract where you're going to lock in that futures and maybe that basis is not set. So you've got a little bit of upward movement you can grab there because you're going to let the that basis hopefully get stronger. And so again, we got a price floor. We're going to set futures, and we're going to let basis kind of ride out there and hopefully get stronger if we think it's going to be an option. But we're trying to give ourselves some protection in case of that pricing if basis goes a different direction on us. The disadvantage to these kind of contracts is that your upward potential gets limited because we're going to set a futures price. You're going to have it limited in terms of what that upward potential can be in exchange for that price floor. And that's where the variations on some of these contracts come in because you're going to see some tweaks to what's getting set. I've seen some contracts um, where the minimum price actually does the opposite, where it's kind of more of a minimum price and a basis contract kind of tied together, where you're setting the basis and letting futures float. You're still kind of limited in terms of where that direction can go. And that's kind of the idea is you're doing some kind of thing in combination where you've got a price floor established to offset downward risk, but you're going to kind of have something that caps the top end that you're kind of hoping to hit that top end as much as possible. Um, and that those premiums you pay in the long run are going to kind of be worth it. Um, so I've just got a couple slides left here, and the didn't take as long today as I had, I think, last week, but maybe that opens us up for more conversation and questions. Um, One of the things that I really want to highlight for people is this pricing decision chart. And this is an old old document, and but it's still really accurate to kind of how you want to think through the markets. And what you're looking at is this idea of what direction is futures going? Is it going up or going down? Which way is basis going? Is it getting weaker? Is it getting stronger? Is that gap getting wider or shorter? And depending on which quadrant you end up with, kind of points you in the direction of um, where you want to think about which pricing contract to use. And so, in a case where start over here in the left upper left quadrant, if basis is getting weaker, so again that gap's getting wider, but futures is going up, so we've got a positive futures direction. Cash might still be going up too, but it's not going up quite at the same direction as what, or the same level of incline as what maybe futures is. And so what we're seeing is we kind of maybe like that basis now because that gap is maybe smaller and we're afraid it's going to keep getting wider. So we could use a basis contract and we kind of force this cash price to kind of stay up and go on that same trajectory as futures price. We can also sell the grain that we have in the bin and buy a futures contract. And we're gonna exit the cash market, enter the futures market, and kind of ride where that's gonna go. Or we can sell the cash, again, exit the cash market, use an option, a call option to give us the opportunity to buy into the futures if we think there's going to be an opportunity for that. Again, trying to ride this price up, buy it at a cheaper price, maybe where it's at right now, with the idea that we can buy in at a later time, buy the contract at a lower time, uh, at a lower price, excuse me, and then we're going to turn right around and sell it because there's going to be a gain. We could use a forward contract to lock in a cash price. So we're kind of setting our exit point for cash. And then we could buy that call option, do the same thing in terms of buying at a lower price and riding that price up in the futures. Or we use a minimum price contract, where we're again setting a price floor and kind of seeing where things kind of go. If you're in the upper right quadrant, now we're in a case where we think that basis is going to get stronger, futures is still going up. This may be a case where we just think pricing and betters is going to be better along the line. Futures and basis, we're going to want to hold off on these. And so that may be where storing your grain, storing cash as it's called, just keeping those bushels in the bin, not necessarily pricing anything, maybe is a good way to go. If you don't have storage, delayed pricing is a good opportunity. You could store the grain and buy a put option with an opportunity to sell at a higher price if you think that we're going to see in case things get capped off in the futures market. Or you use one of these combination minimum price with like a hedge to arrive type contract to give you some price protection in case we're wrong and prices kind of nosedive. But maybe you limit your upward potential and give yourself some risk. If we're on the and over here in the left lower quadrant, where we think basis is going to get weaker and futures is going down, we're worried really about things kind of getting really worse in general. Everything's heading the downward direction. Uh, we think things are going to get weaker between cash and futures. This is where we maybe get out of the cash market. We're going to sell that grain. Maybe we're going to forward contract and at least set our delivery point of when we're going to exit that cash market. Maybe buy a call option in some cases, whether we sell the grain or forward contract to give ourselves the opportunity to buy at a lower price. And again, capture an idea if we think that the futures price is eventually going to kind of cap off, but we can kind of buy at a lower price to sell at where futures is at, gain that difference. That could be an option. Again, minimum price contract may be something to consider in terms of just that downward risk that you want to have. And then the last quadrant is really where we're kind of looking at where we're kind of seeing futures is down. We like futures where it's at. We expect futures is going to go down maybe pretty dramatically depending on the time of year we're at. Maybe going into fall at harvest time. And we think maybe that but in this case, maybe not fall from the standpoint that we think basis is going to get a lot stronger down the road. So we may be at a case where we might be sitting in fall where we like futures price, but basis isn't really good right now. So we're kind of looking out maybe into that January, February, March timeframe where we kind of like where the futures prices are. We can use a hedge where we're just going to store that grain. We're going to sell a futures contract and kind of at least get ourselves positioned to take advantage where we think maybe things are going to go in the futures. A hedge to arrive where we lock in that futures, kind of see if that basis does get stronger, allow us to capture higher price, or we use our put option, store the grain to give us again that opportunity to sell at a higher price, or then we use some of these combination loans again to minimize our downward risk, but give us some upward potential in case markets turn around and go a different direction. And so this is kind of a helpful chart. You take some time to kind of read through and think through the different scenarios and where you kind of maybe want to use some of these. I know that was kind of fast, so if there's questions on this, we can kind of walk through this some more too. Um, but you really, it's an idea of you're wanting to think about where do you think, based on everything you're seeing, and this is where we want as much information as we can about the market environment, both on the global scale for futures price and then in our local markets for basis and local cash price, where we kind of think the directions are, what's the trend looking like for us, because that helps us to decide where we think we're in, which quadrant we're in, and then which of these contract options we kind of think are going to be the most advantageous for us. Kind of my last slide here for everybody is just some closing thoughts. Yeah, there's a great book that's kind of uses this title out of Minnesota that marketing and I put input purchasing is the same way. Is simple. It's just not easy. With marketing, the actual steps, like you can memorize the steps, you can walk through the examples, but it's not easy. We talked last time about the emotions of marketing. When you've got the emotions of marketing in there and you're trying to figure out which contracts to use, um, it takes some time to get comfortable with that. And so you're going to have some time you got to invest in just getting comfortable with understanding where you think the markets are going to go and which tool kind of makes the most sense. Um, I recommend people start by just the basics of following those future prices, those basis trends, kind of getting an idea of where that historical information's been. And then make some marketing plans that use a few different tools. Don't kind of the old adage, don't put all your eggs in one basket. Um, for a lot of farms, I suggest forward contracts, hedge to arrives, and basis contracts are great to get started with. They're a lot more straightforward, a lot simpler. don't have as much money you've got to invest in terms of things like the margins, initial margins or maintenance margins and margin calls. And so it's a lot easier to kind of get comfortable with those. And then the other thing I always like to highlight for people is once you've kind of got a marketing plan and you're looking at some of these things, you're kind of basing your assumptions on where you think the markets are going to go. Get some feedback from other people that that are kind of following the same things that maybe have a good idea of what's going on, what they're kind of hearing and seeing out in the world, what in the news cycle. It could be your spouse, could be you're a grain merchant you're working with, grain elevator. Sometimes your input retailer is really good because they're kind of watching the same markets, even though they might be selling you fertilizer or chemicals. They're looking at the same markets you are. They might have a good idea in terms of where things are going. And your lender, and then of course your extension educator or anyone in extension that you work with that maybe is looking at the same thing is good to kind of just bounce ideas off of. And then I would just put up here my contact information again. This is also in the slide notes. But yeah, any questions anybody has, especially on these things, happy to address those outside of today. And I guess at this point, I will open it up for any questions we've got.
Okay, starting off, we have how often are margin calls made when necessary? By end of every trading day, question mark, or is the time frame spread out more?
Oh, that's a great question. I think it depends on the contract and what that range is in terms of um, what that how volatile maybe that market is. That's a question that I've actually never asked a broker that I really need to because I'm not sure how often. I don't think they're extremely like I don't think it's an everyday type thing. I think there's a little bit of grace period. I might be completely wrong on that, but I think there's at least a little bit of grace period that um, you're at least going to have because I usually there's some kind of balance that my understanding people will usually put into not only the actual initial margin, but they might put down. I've heard at least of where people put some additional monies kind of into like a kind of like almost a bank account to kind of cover so much, and you kind of work that through with the broker ahead of time of how much of that you're willing to do or what your kind of position is. Some of that's why you pay the broker because you're having those conversations ahead of time for depending on which direction things are going. What's your decision on if the price is going to go at this point? Do we stay in? We put more money into it, or do we decide we're going to get out and just cut our losses? And I'm not quite as sure in terms of how that's done, if there's a universal difference. I think the traders maybe are doing things on a daily basis, but there's some prep work, I think, when you talk to the broker in terms of setting up ahead of time how much money you're going to invest. And usually when you run out of the funds you put in there, that's usually when you get the phone call of, okay, the reserve funds you had are when you're going to have to come in and put some more money down. Good question. I'll be honest, I'll have to do some more research to know exactly how that is, but that's the type of question that's great for a broker to see how they do it. And I'm not sure for the panel in the next couple weeks if you've got that anybody like that coming in, but that would be a great question for them because they could tell you how they process that.
Okay. We'll probably add that question to the list for the grain buyers panel just to see what their take on it is too.
Yeah.
Next question we have, are you sure about the 25-cent strike price for soybeans?
Unless it's changed, because those differences on the increments of the 25 cents or the 10 cents, those are set by the CME Group or Chicago Mercantile Exchange, and I pulled those from their website. Oh gosh, a couple weeks ago. So unless it's changed recently, I didn't look at them before tonight. So that could have changed. They ultimately decide what those are. So if that changes where it's different increments, that's a decision with them. But that's kind of the typical where they've been, at least where they were a few weeks ago. And that they tend not to change unless things get kind of volatile. And like example, when wheat prices went up so high, that's when they rose them from 5 to kind of more of a standard of 10 cents per increments. So those certainly can change. But those were what they were the last time I looked at them. So yeah, I'd have to look again to see where they're at today if they've actually have changed them. Good question.
I think I think Jenna did some background checking with that question and it looked like 25 cents was still good. Next question. So is a minimum price contract a combination of being in the futures market and the cash market?
Actually, that's a good question. I would say it is. You're positioning yourself that you've kind of set your exit date of when you're still technically in the cash market because you still have your grain. You haven't actually sold it yet, but you're kind of setting yourself up for when you're going to exit the cash market. And you're looking at that option of locking in. It's kind of back to when we were talking about hedging. It's still technically you're in the cash market and technically, quote unquote, out of the futures market because you've locked in a futures price. Or excuse me, that's I'm thinking of the combo. The minimum price contract, yeah, you're still in the cash market. You are trying to hope that the you're going to exit the cash market where basically you're going to enter the futures market or at a better price. So technically, you're still sitting in the cash market just because of the fact you still have your bushels. Um, but yeah, you're hoping to actually kind of make that transition that when you deliver, you're going to lock in a price at the time you finalize that contract. If you're using a combination minimum price contract with like a hedge to arrive, then yeah, you're kind of sitting where you're kind of a little bit, you're still technically in one versus the other. But the lines I would say are a little bit more blurred because of the fact that you're kind of making movements in both at the same time, that may change your position. So, good question. Because yeah, it's a matter of perspective, but I would say because you still have the grain, anytime you've got those bushels still sitting in the bin, you're still in the cash market. And then if you've locked in a futures price, you're technically, by the way of thinking, you've exited the futures market because you set a price to exit futures on. Like you're going to sell the theoretical bushels you had in the futures market. And so that's one of those things about hedging that you've got to kind of have that mindset of I own bushels in the cash market. I'm theoretically selling the bushels I had in the futures market if I sell a futures contract or I lock in a futures price. And that part, that's the goofy thing about futures is these theoretical bushels that we don't technically have sitting on the farm on those contracts.
Okay. Thank you. We've got a couple more that came in here. Can you walk through the mechanics of rolling HTAs to capture carry? When does this tool make more sense than just selling a deferred contract?
So when you're looking at the difference between the 2 months, so you're looking at that spread or that carry, Um, what essentially, when you're going to roll that H2A forward, the grain buyer is going to tell you it's going to cost you X amount of cents. So let's say I'll use 9 cents that you're going to roll it forward for, say 2 months. Well, for it to make sense for you to go ahead and roll it, you've got to see a carry that's not only going to cover that 9 cent charge to roll the contract forward, but you also have to remember that you're also keeping your grain in storage for another 2 months. So you've got your storage costs on top of that. So if I'm using the same 3 cents I used before per month, that's another 6 cents. So we're up to 15 cents now to roll the contract forward for 2 months, to store the grain for 2 months. So the carry on the market has to be better than 15 cents to really say it's worth doing. And so that's kind of the thought process you want to work through. When you go to actually roll it forward, the actual process of rolling it forward, usually I think it's in when you actually sign the contract and work with the grain buyer, I think it's actually in the contract, or they've at least got a something that you walk through with them on the option to roll it forward that spells out the expenses. But that's essentially the concept is that if you're going to try to capture the carry, you've got to capture the additional costs you're going to incur by rolling it forward a month, 2 months, 3 months. So that's your storage, that's the fee they're going to charge you. And there's got to be enough of an advantage um, to go ahead and roll that forward. If because you're talking about a futures price, you really technically need to have where because you're talking about having locked in a futures price, you actually need to see almost the advantage of where you're going to see a lower futures price because remember, hedge to arrive is actually we've locked the futures in at a higher price, so the carry actually has to go down by more than those additional costs, that premium, your storage, to make it beneficial for you to do that. So as you're thinking about that in your head, remembering that you've locked in futures, so futures has to get worse. It has to get worse more than the cost you're going to incur to make it worth to roll forward where you're gaining advantage. The only thing I would say that makes sense in that case is if you think basis is going to get better too. So you've got to kind of keep in mind that are we going to gain enough where we've got the advantage on the futures market, but then we also want basis to get stronger to make it worth that. So it's kind of got to have the same thing where you're seeing that advantage above those costs to really want to roll it forward. That kind of makes a little bit more sense.
Okay, if someone is wanting to get started doing more than just taking grain to the elevator for the cash price, what would be a good starting point for them?
Um, if you want more than just the cash price, if you're more just than storing it, my first recommendation is probably the easiest one to get started with, um, is a forward contract because there's no fee, there's no premium fees to it, there's no brokerage fees to it. That gets you used to kind of looking at following the futures trends, looking at basis, looking at is that a good price to lock in my bushels for that point in the future I'm going to deliver. And the reason I say that is because you don't have the moving pieces of futures or basis still kind of floating. You don't have the fees, so you want to start out with something that's very straightforward. Of I'm just trying to get a better price down the road than what I've got today, or what I think the price is going to be down the road if I just kind of left everything unpriced. From there, I would say once you've got kind of where you're, if you're comfortable enough with that, then you'd start wanting to look at where kind of do you see more risk? Do you see more risk that basis is moving more often, where especially if you're looking at, especially this is a great use of the basis tool from Purdue. If you're looking at kind of where historical basis has been, and you see it's kind of all over the place, or you see that basis kind of gets a little odd in some years where it's not really following a necessarily a trend, where one year it's kind of all over the place, one place it's steady, and it's kind of hard to gauge, and you think basis has a little bit more volatility to it, then maybe you use a basis contract. Um, and then if you're a little bit more worried on futures because of the volatility there, especially on the global market where prices is going and how some of the trading is going on in the futures market, then maybe you use a hedge to arrive because you want to lock in what you think is a good futures price. So it's kind of that starting out easy with a forward contract, um, being able to identify how you're capturing better pricing, just looking at the direction of where the direction the market says what I can go ahead and secure versus where I think it's going to be if I just left everything to chance for the next several months. And then kind of decide where do you think more risk exists, whether it's in basis or is it in futures, and that points you kind of to working more with the basis and contract versus a hedge to arrive. And then from there, once you kind of feel like you've got those mastered, then I'd say branch out a little bit on some of these maybe combination tools where you're kind of setting a floor, and I would advocate you kind of move that direction where you get a little bit more complex into those contracts before venturing into using futures contracts and futures options, because the investment that may come along with that may be more than, especially for somebody starting out, might be more than what you're willing to kind of put out there at first. And you want to have a pretty good feel for the markets and how things kind of react to things before you get into futures and options and start dealing with some of those. In my opinion, kind of stair step your way that way, where you're just adding on a little bit more complexity over time.
Okay, next question. I heard a story of farmers who had contracted grain with an elevator and then the elevator went bankrupt. Farmer lost his grain and didn't get paid. Would you say that is an additional risk?
Oh, that is definitely an additional risk. I've heard those kind of stories too. Recently, I've heard concerns about those kind of situations kind of coming up in some areas in Michigan and a couple different areas. It's definitely a risk. That's where when you're working with grain elevators, definitely having a place that we tend to be creatures of habit. One of the things I often encourage people to think about is like looking at other opportunities at other grain buyers, because sometimes there's going to be a better advantage to go the extra miles to deliver somewhere else, or maybe it's not so much maybe it's not because of price, maybe it's the turnaround in terms of hauling that you can get them there. You definitely want to be comfortable that the place you're selling to has some longevity to it. We don't have a crystal ball. We don't know things can change. But generally speaking, you can kind of tell. I know an example of one area that I've seen where I know of a grain elevator that's kind of looking at changing hands, and there's been a lot of uncertainty. It's been kind of talked about in the community for quite a while. And so, in cases where those kind of start to come up, you kind of I would advocate have some conversations with the people at that grain elevator about this kind of scenario. And if you're not comfortable, that's where maybe you kind of look at where some other options are. Maybe it is worth driving the extra mile to go somewhere else to sell because you want the security of I'm going to get paid for that grain I deliver. And this happens. It happens in a lot of places. There's been cases where an elevator has shut down because the actual parent company decided to split the territory amongst two other elevators. People still got paid for the grain that was delivered, but it took a little bit longer process because they kind of had to figure everything out about shutting one place down and then moving the books. So that caused some delays, which still can cause some problems. So communicating with the people you're selling to, kind of getting a good feel for what's going on is about the best I can suggest on that. But yeah, it is a concern. And if you start to hear some stories about, or concern in the community that maybe there's some issues there, do your due diligence and maybe take a safer route and go somewhere that's got a little bit more security to it if you feel that maybe is not a good option for you. Good question. Because yeah, that does happen.
How do you leverage the Purdue Basis tool with these contracts?
If you're starting out especially and you don't have familiarity with how some of the grain elevators work, because the nice thing about the Purdue Basis tool is that it's regionally based. So, like last time, I had shown an example where I put in Elkhart as kind of my spot because I decided I wanted to see kind of what the range looked like near my house and in the region I'm in. And so when I was looking at that, it kind of gave me a good idea of what historically the last couple years had looked like compared to where we are now. And that's a really good starting point. That if you're not familiar with kind of the pricing habits of the elevators you're looking at, especially if you've been just kind of storing and pricing later, and you want to kind of get into using some of these other options, these other pricing tool options, I should say, that's a good place to start to learn kind of what's been going on regionally. You still want to compare because that it's regionally based, so it's pulling in data from a lot of different sources, and you want to compare to what your local elevators may be doing because their data is maybe being funneled into that, but it may be masked a little bit based on some of the other data coming in. So that's your starting point to kind of tell you what's going on. And then you can kind of go look at the most local place you're kind of thinking about selling. And then you start looking at the other elevators too to kind of see what's the difference because what's that cash price that's being offered? What's the basis that's out there? Everybody's working off the same futures price, but then you can start to compare and contrast on who's actually got the better options for pricing. And then you start to look at the differences between, well, how much further do I have to go? What's the discount schedule that you want to kind of pay attention to if they're charging you extra for moisture, test weight, those type of things. It all starts with kind of getting a feel for what's going on in the region and where pricings are kind of going on basis. So that tool is a great starting point to then go dive deeper and say, all right, where's my opportunities within the region where I can capture this difference I'm seeing. And it doesn't take you too long. You can kind of figure out where some of that data is from and give you a good starting point, good direction on where to go. I think that tool is great for doing that.
Okay. Are futures contracts typically better for bigger farms where you have more wiggle room with the amount of bushels you're producing overall? If so, what are the best tools for small farms?
I tend to think of futures contracts and futures contracts themselves as more of the larger farms just because of the amount of money that's involved in terms of managing a lot of those. And but that doesn't mean that a smaller farm couldn't get into those. It's really about how much money you're willing to invest into doing them. And so I tend to think about the fact that larger farms, economies of scale, they maybe have more working capital they're working with, so they might be more comfortable at doing that. The fact that you're not realistically looking in most cases to actually sell the bushels you have on the futures market or to take delivery of any bushels from the futures market, it really opens up that it's for everybody. And I know small size farms that have, in fact, I know a couple people in my home area that one of them does trading all the time now. They got started out as a small farmer, just doing little trades here or there, and actually kind of getting comfortable in the market. They start out using put options and got really comfortable just on a small scale, and they knew how much they kind of wanted to invest to kind of get comfortable, did their homework ahead of time, and now they're pretty darn good at it. And so it's one of those things that's about your own comfort level, your own risk adverseness, in terms of venturing into the futures market and how much you want to invest. I tend to think again larger farms just because they've got more money, but that doesn't mean they're going to be better at it. If you've got the time and the energy and the money that you want to kind of get into looking at that, a small farm it works great. From a The best options I typically see for a small farm is more of the forward contracts, the hedge to arrive, and the basis contracts, maybe some of those minimum price combination ones, just because of the fact that we're not talking as much money you've got to invest into those. And again, it's the idea of you're dealing with people you know, there's that relationship that exists. And I think that's really important for small farms trying to get established or trying to grow is relationships make or break farms in the long run. The large farms have a lot of good relationships too. But for a small farm, especially if you're a starting out farm, and you're still trying to get those relationships established, those are the easier ones to work with. And again, you stair step your way into the other options as you go along. But those are your good entry points because you again work with people you know and kind of makes it a little easier to understand what's going on. Good question.
Okay, so we have got a last question here. As far as elevators changing hands, ours has been bought and sold 2 times of last year. Are the contracts binding when selling grain contracts when they pass from one buyer to another, or have you seen a new owner kick back a contract?
Ooh, legal question. Um, it depends. Typically, when a business is sold, um, it the typical process is that the business, including the clientele, um, is that clientele list is kind of sold with it. One of the things that if it's been bought or sold and they're basically buying the debts that exist out there, so if they owed somebody money on grain and they're just buying that up as part of the business that they're going to take care of that, then that contract is supposed to go with the business. Now, there can be some cases where part of the actual buying and selling where they're going to clear the debts out. So any grain that would still be need to be paid could be paid out as part of that. Um, but if the business itself is kind of sold, turnkey, the whole thing is sold, and everything is typically sold. Where so anything that they've got in terms of debts, those type of things either have to be settled or they're going to basically take on the agreement that as the new owners, they're going to see those through. It gets really hairy though, with really, really sketchy when you start talking about changing hands. It's all what's within that contract. Technically, what typically happens for a business is if they A lot of cases, if it changes hands, now twice in 1 year kind of gets sounds a little concerning. Um, but typically when it changes hands, the idea is they're going to make good on those contracts because, well, number one, they want to make good on those contracts because they don't want to lose the customer base they have. They don't want to alienate anybody to begin with. So they'll usually make sure those are paid. Now, if a business is going under and you see the other case where they're just going out of business, then you kind of go into the question of, am I going to get paid once? Because they're probably going to file bankruptcy and you got a whole bankruptcy issue in terms of who gets paid. But generally speaking, if the business is a turnkey sold that way, you're going to see them try to honor those contracts. Now, there could be some finagling with the attorneys and how that works. There's definitely a legal precedent that you had a contract that if you sold those bushels, you owed money from that business, and if that business is still technically running with just new owners, my understanding, and I'm not an attorney, and I would say you'd want to consult an attorney on this, but I would think you'd still have that position where contract is still in existence, unless you've been told otherwise by an attorney. So I would do some legal checking if that's the case and to see what actually is in that contract. Review that contract and make sure there's not a clause in there, especially if you've been in a case where there's maybe a little bit of a concern because if you sign something in between, the fine print is always the most important thing. And if you've got a contract sitting out there, definitely have an attorney review it and make sure you know kind of what the situation is. But I would hope that they're going to honor that, and that was the intention because again, they don't want to lose their customer base, and that's generally how most people kind of handle that. That's a good
Okay,
question.
so
That's a tough one.
yeah. So last thing is we've got somebody wondering about kind of diving deeper in popular forwarding contract strategies or frequency, volume of contracts, things like that. If you had any recommendations of resources or places to send people to dive even deeper on these details, do you have anything you would recommend?
Um, yeah, actually, if I'll stop sharing here, see if I can pull up a website that actually is to kind of learn the steps, especially on uh futures contracts. There is this fun fun thing in the let's see here. I will share my screen again so everybody can see this. There's this fun, we call it the fantasy grain marketing or the trading game called Commodity Challenge. This is a tool designed to actually help you understand some of the basic, especially around the futures market, especially around options. Um, it's a free thing you can and log into, and it's a game basically that you walk through all these steps, and it's probably the number one teaching tool that I recommend for people because as it highlights here on the screen, you are using live market data. So you're doing stuff in real time, learning this stuff. So commoditychallenge.com. Um, try to put that in the chat here, I think. If I can get it to, there we go. I highly recommend that for people because it's probably the number one place to just learn as you go. And sometimes trial and error is your best teacher. And you don't have to invest any money in doing it this way. So I recommend this as kind of the best option to look at.
That is awesome. Thank you for sharing that, John, and thank you for being on here the last two sessions and leading us through all these details and challenging topics. Um, we are going to take a 2 minute stretch break and be back here like 8:11 so we can go into our risk assessment activity. But thanks, John. This has been awesome. We really appreciate you.
Thanks for having me. Always a pleasure. And any additional questions, I'll stay on for a little bit longer in case there's some additional questions. I can happily try to answer those.
All right. Alrighty, so we are going to switch over to our nightly activity, and I'm going to hand that over to Jenna to talk about this risk assessment tool.
Yes, so tonight, John kind of said, everyone's got different tolerances in terms of risk. And so we have a risk assessment tool that we wanted to share with you and talk you through. This tool was developed back in 1999 through University of Wisconsin Extension Ag Ventures program. We received approval to use it from Katie Wantock. But you should have received it in your when I sent out the email, and I'll go ahead and pull it up so you guys can see it. Now, where is it on my screen? There it is. And so it looks like this, where you have the risk tolerance evaluation. And so hopefully you are able to find it. If not, look for that email from me, and you should have access to it in there because I know it was an attachment there. But we hope that you have it, and we're going to start by taking a pencil or pen and reading through all the different words under column A, B, C, and D. And so any word that fits you best, circle it. And so you may circle two under column A, two under B, four under C, five under D. But go through each of the columns and we'll pause for a few minutes for you to be able to circle all of them on there. That matches up with your um, personality. If you are done, um, if under each column you put the number, so like under A, if you circled two, put two, B, however many, that does help when we do the tabulation in a minute or two. So I will pause for another minute or two to let anyone else catch up. Okay, so I've had several say they're done, so I'm assuming you've finished part one. The next is your turn to part two, and there's 5 questions. And you want to read the question and then select the answer, either A, B, C, or D, that best answers the statement. So, in the first part, which of the following statements best describes how you feel about investments? And you'll put your answer next to the number, and you'll do that for all 5 questions. Once you're done, again, please type done in the chat so I know when we're ready for the next thing. Okay, it looks like I've got several that say they're done. So the next part, I will admit, gets a little tricky. And so for the scoring, it's at the bottom of page 3. And for under part 1, you're going to count how many of the words you circled in A, column A, and put that number there. The same for B, C, and D. The tricky part comes when you score part 2. For part 2, you'll look through those 5 questions, and let's say you circled A twice. You'll do 2 multiplied by 2 to get 4 for A. If you did 1B, it's 1 times 2 for 2. If you did no C's, 0 times 2 is 0. And let's say you had 2D's, 2 times 2 is 4 again. So again, however many you circle in part 2, or how many answers for each letter, it's always multiplied by 2. Once you put your answer in for part 1 and part 2, add them together to get your number on the far right-hand side of the screen. So again, I'll pause and let you guys tabulate. All right, looks like I'm getting several saying they're done. So we will go ahead. And so what we're curious about is what your highest number was. So do we have anyone that wants to say that their highest number was A? Well, those of you with the highest number of A, you guys are considered our avoiders. Avoiders are extremely cautious about trying anything new and tend to be suspicious of anything that hasn't been proven and practiced for many years. They may make remarks about new practices or procedures that indicate their refusal to try them, such as, don't fix it if it ain't broken. Somebody tried that 20 years ago and it didn't work. A lot of people lost money trying that, and I'm not risking my farm. While avoiders may sound pessimistic and negative in their comments, they are likely asking questions to get information that will help them make decisions. It is important that they have the information and time to think about things thoroughly and then ask more questions. Change can be very difficult for avoiders. They are risk adverse and are comfortable doing things that are proven and demonstrably low risk. If your number was B, if your high number was B, then you are considered a daredevil. Daredevils are masters at making quick decisions. If someone even hints that a new idea might be successful, they will give it a try. This style particularly likes to have fun with risk taking. They are spontaneous and can change direction in the wink of an eye. They may not want to keep doing things the same old way because it's become somewhat boring. The daredevil tends to do more gambling in the area of risk and will go for broke in their risk taking. In fact, they may even take unnecessary illogical risks simply to be different. Daredevils have a great ability to figure things out and solve crisis situations. Thus, their tendency for risk is higher than any of the other styles. If your largest number was C or highest number was C, then you're considered an adventurer. Adventurers enjoy taking risks, but they like to have all the answers, or at least most of them, up front. They are the innovators in agriculture because they have a great ability to envision the future. As visionaries, adventurers study, collect information, then plunge into new adventure or practice. They may become convinced that the direction they are going is the right one. Adventurers have a natural ability to conceptualize new plans and then put them into action. Like the daredevil, they enjoy the fun of the risk. And if D was your highest number, then you are calculators. Calculators are somewhat conservative risk takers, but are willing to learn. They recognize that risk is necessary, but it is important to change in a calculated way to keep risk low. This style tries to find out all the answers before jumping into something new or different. Their decisions always take into consideration their family and community. They also have a great desire to sustain and maintain agriculture in their community. Calculators are very good at making decisions and do it with a great deal of structure. So, with that being said, I gave you kind of a brief overview of the four. In the packet, you have even more detail about each one of those um, different types of risk or risk tolerance types. But we would like to have a little bit of discussion if anyone would like to chime in and say whether you were surprised by what your risk tolerance type was by doing this.
What are you, Jenna?
Calculator.
Same.
Hmm, so,
I was not surprised by my result.
I wasn't either.
Okay,
Anybody
I
else
kind
a
of wonder if
calculator?
that's, oh, sorry. I kind of wonder if that's a woman thing because I remember in Purdue we did like the commodity challenge and like
Mhm.
all of the girls were very conservative in what they did and all of the guys were just like taking all the risks, but the guys ended up coming out really well because, risk sometimes means reward. So,
Yes.
I did this over the last week at the Ag Engage conference, and we had a few adventurers in our group. Hmm. Anyone else want to share? Oh, so, Robert said he's a calculator, but is also a man. And Nick. And I would say there's a good chance that with calculators, you're wanting to learn things. And so we might have a idea that you're leaning towards that one because you guys are taking the class and learning more.
I find as a calculator that I can just get stuck doing research and research and research and research and never actually like pulling the trigger and wanting to make the decision.
So another question that we had was now that you know about the other types of risk tolerances, can you think of individuals who might fall into one different than you? And the final question that we had was, now that you know your risk tolerance type, how do you think you could maybe use this to help you make decisions or work with others?
Nick
Oh, Nick
says
shared that his father is also a farmer and is an avoider. Yeah. Like I said, we did this last weekend at the Ag Engaged conference, and one of the participants said they could see their father-in-law being an avoider, and they wondered if it might be a generational difference. Oh, Ben kind of alluded to that too. Said I think most that experience the 80s are probably avoiders.
yeah. It's good to have an adventurer on the team though that can push you into actually making decisions once you get in that kind of stalled position. His hero is Jack Benny.
Well, one thing to mention now that you have the risk tolerance tool, you're more than welcome to print it out. And if you have farm family meetings, you're much encouraged to maybe have everyone do this, just so you can kind of get to know each other's personalities. Um, Using it, it might be something enlightening for some individuals on the farm, but it's something you can print and use again if you'd like. Um,
A
and
good
then
tool
Ben
to
said,
start discussions with your
yeah.
family.
hmm And Ben said it's easier to try things when margins are better. Yeah, it's when things are better, it's a lot easier to try things. We know that. Well, Courtney, we're at the end of our time, so do you want to kind of wrap it up for us and talk about next week?
Sure. Well, thanks you guys for being on here tonight, and we hope it's going well. Please let us know, shoot us emails or anything that you want to make sure we cover with Ben Brown, who is going to be our Ag Outlook speaker. Ben is from the University of Missouri. He is a senior research associate with the Food and Agriculture Policy Research Institute. I heard him give an Ag Outlook talk not too long ago, and it was excellent. And so I'm excited to hear him again. Feel free to contact us also with questions for the grain buyers panel for that fourth session, too. Other than that, I think that's it for tonight.